Inflation concerns are mounting from the nearly $20 trillion in fiscal and monetary stimulus released across the world in just 2020. This is changing the rules of investing, and most folks with traditional portfolios are going to be caught completely unaware by this, warns real estate expert Victor Menasce.
So you're not playing by the rules that the rest of the folks are playing by, and you're going to get clobbered because you don't know the rules. And if you thought for a second that the game was how do you win in an inflationary environment, you play the game very differently.
Hello and welcome to Peak Prosperity. I'm Peak Prosperity co-founder Adam Taggart. And as usual, we are here to make sense of the markets and of money in general. This week, we want to talk about real estate. You know, when the topic of investing comes up, most people immediately think of the financial markets, right? Stocks, bonds, et cetera. But interestingly, the number one most preferred investment by Americans is real estate, and it's for compelling reasons. Real estate can produce inflation adjusting income along with equity appreciation over time, while also enjoying tax advantages that stocks and bonds don't benefit from, which is why we're very fortunate today to be joined by Victor Menasce. Victor is a seasoned real estate investor who purchases and develops properties throughout the US and Canada. In addition to his focus on producing returns for his investors, Victor is an educator who's passionate about helping regular folks understand how they can use the advantages of real estate to generate inflation adjusting income streams. Victor, our paths tend to cross at least once or twice every year. COVID's kind of thrown a monkey wrench into that, but it's really nice to be able to connect with you live here, at least virtually. Great to see you again, and thank you so much for coming on the program.
Well, it's great to be here again. Thanks for having me.
You're very welcome. Well, look, let's just jump right in here. Can you just give our viewers a quick background on the benefits of investing in real estate and the role that it can play in a diversified portfolio?
Yeah, absolutely. Let me start by making a bit of a distinction between the different forms of real estate. I want to separate what happens in the world of residential real estate versus the world of commercial real estate. There's so many different asset classes. We see things in the press about the risk of investing in real estate, and the long shadow and the memory of the post-2008 is probably still fresh in people's minds. So we want to make a bit of a distinction about what happens in the world of residential versus commercial. And if you think today we're in the COVID environment, there's certain asset classes, even in commercial, that are suffering. We think about hospitality, we think about office, we think about retail. All of those asset classes are a little bit discretionary, and therefore they're suffering. So when we tend to talk about real estate, our focus is on those classes of real estate that are essential, which means housing. People still need a place to live, but we're talking about commercial real estate, not residential, because the way commercial real estate gets valued is different than residential real estate. Residential real estate gets valued because maybe your spouse likes the way this place looks and they like the view and they're willing to pay more for that. Commercial real estate doesn't get valued that way. It gets valued as a financial asset, the same way that you would value a treasury bill or a stock or a bond. It's based on multiples of net income, and it's not speculation. So it's a very different way of looking at an investment. You got to look at these as you would look at any paper investment, except it happens to be a real asset.
Great, thanks for that. And you very rightly emphasized something that our friends Robert Helms and Russell Gray of the Real Estate Guys, they say that, don't think of real estate as an asset class. Think of it as many different types of asset classes because they all have their strengths, weaknesses. They perform differently in different market environments. All right, so you tend to invest more in commercial real estate, and you mentioned how commercial real estate is at least in theory, supposed to be valued on as the discounted flow of the income streams that it produces. You gave a little bit of nod to COVID, but right now we have an awful lot more people and more businesses that cannot afford the rents that they were paying before COVID came along. So, what's happening in the industry right now? Like how badly is it getting hit, and which parts of the industry seem to be doing better and which parts of the industry seem to be doing worse?
The two brightest lights in the industry right now, again, I'm speaking commercial, are industrial real estate, warehouses, refrigerator warehouses, anything like that, are under, experiencing tremendous demand, strong rent growth. You see fulfillment centers popping up all over the country. You see e-commerce looking for more space to replace the retail space that is shrinking. So that's certainly one asset class. It's not our focus. The second area that I would say is doing really well is multifamily. And that falls into two classes. First would be, the typical garden-style multifamily apartment complexes that you see all over the country. But there's an increasing asset class as well, which are almost like executive townhouses, but purpose-built for rentals. People like to live in a single-family home. They may not necessarily afford a single-family home, but they like something that lives like a house. So there are a lot of purpose-built communities coming together specifically as rental assets. Rather than just going out and buying a bunch of single-family homes and renting those, these are purpose-built communities. So we like those in general. And I would say those are the two areas that we would focus on in today's environment as doing the best. You talked a little bit about COVID. Rent collections in residential real estate are quite high. They're well into the 90s. It's a couple of percentage points off what it was compared with the pre-pandemic numbers, but we're not seeing the cataclysmic predictions that were made early in COVID about, people not paying rent. That we've not experienced that at all.
And I'm curious, how much of that do you think might be tied to the fiscal stimulus that has been, increasing people's unemployment benefits and sending checks in the mail and stuff like that? Is that allowing people to kind of continue to pay the previous market value rents? And if so, is there a concern that you might start seeing defaults once those checks end?
So it's a very good question. Certainly the amount of stimulus that's coming into the marketplace has created a little bit of an artificial environment. The moratorium on evictions has created an artificial environment as well. And having said that, all the noise is out of Washington right now is they're not going to let the population flounder. Certainly the majority of the hardship that's being experienced in the COVID environment are in that tenant class. If you look at who's lost their jobs, it's people that are in hospitality, in restaurants, in retail, hourly paid workers, factory workers. It's not the hedge fund managers. They're gainfully employed, So it's really the folks that are kind of at the bottom of the economic ladder that have suffered the most. They've suffered disproportionately, and yet we're still seeing very strong collections in rent. So the only conclusion we can really draw is that stimulus is working.
Okay, great. And I'll get into in just a few minutes sort of what you think the key factors are to consider when investing in a certain property or property type. Just to give an example, that you can invest in multifamily, but then you got to determine where along the spectrum of multifamily do you want to play. And what we often hear from people is it's smart to play in sort of moderate properties or middle tier properties, because in a economic boom, you get people at the lower ends who are competing to get into the property as they become, more wealthy. And then in a recession, you have people from the higher end competing to come down in as they're downsizing, right? So that's sort of one example where if you have a good property, it can actually do well in different market cycles. But before we get there, just a quick question for you. For people that have not invested in real estate yet, but are sort of intrigued by the idea of it, can you just sort of give a minute on the benefits of doing so as an investor versus investing in stocks and bonds? Sort of why invest in real estate as a regular investor?
Well, certainly if anyone is listening to this, chances are that they've listened to the crash course or watched the crash course and understand the impact that inflation has over the long term. So I'll just give you a very simple example. Imagine for a moment that you bought a property that was, let's say, $1 million, and you put down, let's say, the minimum 20%. So you put down $200,000 and you borrowed $800,000 from the bank. So you've got that typical 80-20 loan to value, loan to cost ratio. And let's say that inflation's running a little bit higher than the government is projecting. Let's say inflation, just to keep the math simple, is running at 10%. So a year from now, that property, instead of being priced at $1 million, is priced at $1.1 million. I don't want to say it's worth $1.1 million, because that gets us down a whole rabbit hole of philosophy, but it's priced at $1.1 million. Now, even if you made almost no principal pay down in that first year, you still roughly have $800,000 in debt, but your equity's grown from 200,000 to 300,000. Now, the mathematicians in the crowd are probably saying, well, wait a minute, Victor, that 300,000 is not quite worth 300,000 in last year's dollars. So it's worth now, let's say 10% less than that, it's worth 270. You've still made very, very good return on that equity investment just through that extra leverage. And that is the game. You know, we talk about playing the game. And the question is, do you know the rules of the game? Most of the people are playing the game. They're out there on the field. They've got the ball in their hands. And this other team comes out, except they got helmets on and they've got padding. And they, you know, you think you're out there playing rugby, but it's actually you're playing football. And you just don't know it. So you're not playing by the rules that the rest of the folks are playing by. And you're going to get clobbered because you don't know the rules. And if you thought for a second that the game was how do you win in an inflationary environment, you'd play the game very differently. And that's really the benefit that real estate gives you, especially with a modest amount of leverage. All of the benefit goes to the equity holder, and the depreciating asset is the loan. The depreciating asset is your savings in the bank account. What gets wiped out in inflation? People on fixed income, their buying power gets wiped out. Debt gets wiped out and savings get wiped out. So you want to play the game so that you're on the winning side of that trade. That's it. Nothing more complicated.
That's a great, I think, simplistic way to say it, Victor. So that is a great job. And just to emphasize your point there. So we've had a number of very august economic and financial thinkers on this program over the past couple of months, who have been saying that by their calculus, the odds of inflation have gone up pretty dramatically over the past year. No big surprise. I'm forgetting the exact number, but I just saw the stat that it was literally something, I think, nearing or in excess of $20 trillion that has been in stimulus that's been ushered throughout the world over the past year, if you add up all the different monetary and fiscal stimulus programs across all the major countries. I mean, it's just a massive wall of liquidity that's going into the market, and more dollars means more inflation. That actually is the textbook definition of inflation, is an increase in the money supply.
Right. But well, if you look at it even from a consumer price index perspective, I mean, all of the rhetoric around, for example, increasing the minimum wage, absolutely people are struggling, and getting the minimum wage up is going to benefit some people temporarily. But if someone is making $15 an hour right now and the minimum wage is now 15, guess what? That person's going to feel like they've moved backwards. So they're going to be going to their boss saying, you know what, I need 20 bucks an hour now. And it's going to trickle through the economy. It's going to raise prices locally for anything that's manufactured locally. It's going to give advantage to those products that are imported, unless, of course, the dollar falls, which it probably will. But at the end of the day, that's all inflationary.
It is. And one thing that many people don't understand is programs that give money directly to households, they tend to be much more inflationary than the other types of stimulus, because that money gets spent immediately and increases the velocity of money in the system, which drives prices up. And I don't want to get too caught around that, but it's just an important thing to keep in mind. So, as you said, Victor, real estate is great because you have the leverage that debt gives you to be able to make the return that you calculated, right? Your example there was almost a 50% return in 1 year. And hey, that's not guaranteed, but you give an example of how that can happen, with the leverage of real estate. You talked about the income stream, that you get from real estate. And again, we call those inflation adjusting income streams. So like you said, a bond, you buy a bond, you lock in what you're going to get from that bond as an income stream, and that gets depreciated in purchasing power as inflation rises. But if you're charging rents adjust with inflation, right? And so, as somebody who's invested in a rental property, you're able to, basically move your prices up along with inflation. So you're sort of protecting that purchasing power. And again, another important thing about real estate is that that income stream over time, you can use to pay down the mortgage, pay down the debt you have on the property. But again, in a highly inflationary environment, inflation's doing a good job of reducing the cost of that debt to you along the way. So I just want folks to really understand that there are multiple advantages to investing in real estate that you don't necessarily get in the financial markets. The last thing I want to ask you about on this topic is real estate does enjoy certain tax benefits. Can you just talk about one or two of them so that people have a general sense of how real estate can differ from a paper asset like a stock?
Absolutely. So when you get income, net income from the property, it comes out in the form of a distribution. And you typically will also charge as an expense against the property depreciation. So that depreciation will vary from one year to the next. If you do something called cost segregation, which means that you're going to look at the property in its constituent parts, the roof is going to depreciate at a different rate than the refrigerator is going to depreciate at a different rate from your carpeting and so on, you can accelerate some of that depreciation. This is work that is done by the accounting team that's supporting the real estate investment business. What that does is it often creates a situation where when you add that depreciation expense that flows through alongside the income, you can often zero out that quote-unquote profit so that a lot of that cash flow comes out almost tax-free. That's one of the real benefits of real estate. It's one of those things that's we don't believe is going to be challenged with the new Biden administration. That's one of the principles of investing in real estate that's been around since the beginning of time. There are things that came into play under the 2017 Trump tax law that might disappear, like bonus depreciation, which really accelerated it into 1 year. That may disappear, but the basic concept of depreciation that's been around for a long time is still at play, and it allows you to pull a lot of that income out, that cash flow out, almost tax-free on an annual basis.
Great. And real quickly for folks, when Victor said it sort of zeroes out the income, you're actually still getting the income. You're getting the cash. It's an accounting adjustment. And so the depreciation is a paper expense, basically, you're taking that year. So you're still getting the cash, but from a taxation standpoint, the government's subtracting the depreciation from your taxable income. And as Victor said, it might say, oh, it looks like you actually made $0 this year, even though you got cash in the door.
Exactly.
All right. So Victor, let's switch on quickly to, I'm not trying to give people a crash course in, the ins and outs of real estate investing here, because we just don't have the time, and you're doing great so far. But if you could, you mentioned that, residential real estate, multifamily real estate is, still an attractive asset class right now, given the current market dynamics. Can you just give folks a general sense of when you look at a property, whether it's when you're going to buy or when you're going to build, what are the, kind of success factors that you most look for to determine whether it's going to be a good investment?
So let me put it from the perspective of someone evaluating an opportunity, not just something that we would evaluate, but let's say someone puts an executive summary in front of you. This is what you should look at. You should look at three things. Number one, you should be looking at the submarket. And when I say that, I mean that real estate is hyper-local. If you pick any city, let's say Austin, Texas, the west side and the east side are dramatically different. The north and the south are dramatically different. You want to really be looking at it almost by neighborhood basis, so that you understand what's happening in that neighborhood in terms of rents and all of the rest. So you want to look at that submarket. What you're looking for is influx of population, influx of jobs. I don't ever, ever, ever want to be in a shrinking market. I will not, and this is just Victor's philosophy, I will not invest in Detroit. Nothing wrong with Detroit, but their population has cut in half over the last 30, 40 years. There's a reason you can buy houses for under $30,000. It's because there's more supply than demand. You want that supply-demand imbalance where there's more demand than supply, and you want to see that imbalance persist for a good long time. So I want that kind of upward pressure on prices. I want to see that upward pressure on rent, and I want to see that influx of population. So that's paramount, number one. Number two, you want to look at who the operator is. What's their track record? You don't want to be necessarily investing with the two guys in a pickup truck class of operator. You want to be looking at the folks that are established, that are really investment grade operators that have a strong track record. And then number three, you want to look at the specifics of the deal, which means you want to be looking at the multiples, and are they conservatively underwritten compared to the rest of the marketplace. So you actually want to look at that market study that comes along with the executive summary. I know it's a lot of pages, but you want to look at it and see that it's been underwritten conservatively. no different than you would for a stock or a bond. You wouldn't want to buy a stock that's trading at 50 times earnings, all of the things being equal, if the rest of the market is trading at 15 times earnings. You don't want to overpay for something. So I would look at those three things.
Okay, great. And you're really, you're talking about an approach that I was just about to ask you about, which is syndication, or basically buying into a deal. So, people can invest in real estate directly if they want to. You can buy a building and become a landlord, right? And go out and find tenants for it and do all the property management and all that stuff. There's a lot that goes with that. That's not for everybody. And it can be costly to come up the learning curve there. Also, you're very limited by how much capital you have to invest. In other words, if you've got, $20,000, you're not going to be, buying a hospital and renting it out to a hospital management group, right? But with syndication, there are people out there like Victor and other people in his industry who, they amass the capital from investors. They put together an offering and they say, we're going to buy this building, this apartment building. It might have, hundreds of rooms in it. Or we're going to buy or build this, commercial property or hospital, whatever it is, or sometimes you even develop them on your own too. And what that does is it gives people the ability to basically ride the coattails of an expert real estate investor, right? So if you don't have a lot of experience, you can get in a deal that's being run by somebody with a lot of experience. You can get into deals, again, that you couldn't otherwise get in on your own because the properties are just much bigger properties, much more expensive. And then third, you don't have to learn the ropes the hard way by getting calls at 2 a.m. because the plumbing broke and whatnot. Maybe there's not much more to say about syndicates than what I just rattled off there, but if you've got anything to say, please do, because I think a lot of people watching here may not actually know that model exists and may find that more sort of, it doesn't have to be entirely passive, but that sort of much more passive way of investing in real estate attractive, or at least attractive as a first step.
I would make the distinction. There's a lot of people out there watching TV shows of flipping houses and all of that sort of thing. And quite frankly, that's not investing. That's a job. Money comes in one of three ways. It comes either as earned income, as residual income, or capital gains. Or maybe the fourth one might be a government check. But it's either earned income, residual income, or capital gains, one of those three. Flipping houses is not real estate investing. That's manufacturing. Your inventory is all the materials, including the house that you just bought, that you're going to go and improve. That's a manufacturing business. And so it's a very active business. If you go and spend 3 months on the beach, everything comes to a stop. That's an active business. And even owning and managing an apartment complex, if you have a 250 unit apartment complex, that's an active business too. It's not a passive business. You can invest passively in that active business and you can get residual income from that investment. At that point, it's an investment. Anything less than that, if you are actively involved, well, that's just another job by a different definition. So you want to make that distinction. If you think about where most of the wealth in the world's been created, it's been through some combination of residual income and capital gains. It's almost never been through that earned income approach.
All right, very well said. So, all right, well, as you wrap up here, for at least this first conversation, Victor, it's such a big topic. I'd love to have you on again to dig a little bit more deeply into it over time. But real estate it's got a lot of advantages that we talked about. It is much less liquid than, the common stock or bond or whatnot, right?
Correct.
You can't just, and also too, it generally requires a larger capital commitment, right? You can't put $5 into a property and you can't sell it, in the next minute if you decide you want to, right? So if there's anything about those, sort of the eyes wide open, things you'd want folks who are considering investing in real estate to know, please state them. But in answering that question, I would assume, and I don't want to put words in your mouth, but after I'm done talking with you, I'm going to talk with the lead partners from New Harbor Financial who are on this program every week, who are financial advisors. I would imagine that you would say, before making a real estate investment, especially if you're relatively new to it, you should work with the, under the counsel of your financial advisor to make sure that you're answering, these important questions correctly. How much should I put in? How should I fund it? Should it be just straight cash? Could it come out of a retirement account? That type of stuff. So I would assume that you would say, look, it's a big decision. Take it into account with your full financial situation and listen to your financial advisor. But if you disagree, let me know.
No, I think that's right. I know Mike and John from New Harbor, and they're not like your typical financial advisors. A lot of them are, I'll say, glorified salespeople. If they don't collect a commission on what they're selling you, they're not going to recommend it. So there's a lot of financial advisors out there that are basically just selling product that they've been told to sell. I don't think New Harbor are like that. They're really fiduciaries and looking out for investors' best interest first and foremost. So first thing is make sure that you're working with the right kind of financial advisor, not just someone who's a glorified salesperson. Because if they're not going to make any money off of recommending a real estate investment, they're not going to recommend it. It's that simple. I think it's a part of your investment strategy, part of your investment portfolio. I wouldn't necessarily make it everything, but it's a fantastic way of getting an inflation adjusted, risk adjusted return on your money for the long term. You're right. It is not as liquid as say a stock that you can sell in the next 3 minutes, but if your aim is long-term appreciation, if it's long-term wealth protection, in my view, this is what I do day in, day out. I can't think of anything better.
All right. Well, thanks so much, Victor. I'm going to give one shameless plug for Peak Prosperity's 6-episode, 12-hour-long webinar series in real estate investing, how to invest in real estate for safety and profit, which Russell Gray and Robert Helms, who I mentioned earlier, who are really good colleagues of Victor's, helped put together for us. But we've just scratched the surface of the surface of the surface of the iceberg in this discussion. And if you want to delve more deeply, the first 2 hours of that video webinar series are completely free to watch. So I'll put the URL up here. And if you're interested, go watch that first episode. And if you like what you see, keep digging in there. Now, Victor, thank you so much for sharing so much of your time. And I think you did a phenomenal job of taking what can be, somewhat of a foreign, complicated topic to people and making it really understandable. So if people have been inspired, if they want to learn more, if they want to follow you and your work, maybe learn about some of the properties that you and your firm have coming up in the pipeline, where should they go?
Well, they can connect with me directly at my website at victorjm.com, or if they just want to learn more over a period of time, I'm the host of the Real Estate Espresso podcast. It's like the Italian coffee. That's a daily show 7 days a week, and it's a short form show, 5 minutes, just me on the weekdays, and we have some amazing guests on the weekends, including yourself. You've been a past guest a couple of times, Adam. So the Real Estate Espresso podcast would love to connect with you that way as well.
Great. And highly recommend, if you're kind of interested in this topic and want to learn more about it, beginning to listen to that podcast is a great way to get onboarded very quickly. Victor's a phenomenal host and very gracious, as I'm sure you've already realized by listening to him. Victor, thanks so much. We'll let you go here and get back to your important work. But again, thanks so much for the time. And I look forward to having you back on later in 2021.
Thank you so much, Adam.
All right. John and Mike, another week, another phenomenal guest. So I want to talk to you guys about your reaction to what Victor had to say. I think he did a really gracious, kind of nod to you guys as being different from the standard type of financial advisor who oftentimes will kind of talk people out of investing in real estate because it just means less money going to the financial advisor to get fees off of. So if you guys, let me just hand you the football, but I know that you've helped a lot of clients think through how to invest in real estate. You've helped them take money out to make purchases and whatnot. And I know it's a core part of what you do. So John, why don't we start with you about the approach, and then Mike will let you chime in.
Yeah, that was a very kind gesture that Victor just threw our way, and we'll humbly accept that, because we do that quite honestly quite a bit. We look at we have a fine business, a fine livelihood, and the psychic income of always doing the right thing is far outweighs the incremental paycheck of trying to extract every dollar out of a prospective client. We learned that long ago. It's just it's not in our DNA to do anything but what we think is the right thing, and the right thing almost invariably involves clients having many things attended to other than the things that we can do for them. We're big fans of tangible assets like real estate. Obviously, everything comes with caveats. You want to pay the right price. You don't want to get yourself into something that you don't have the aptitude or desire to hands-on manage or look after. Multiple diverse streams of income. We think of diversification not as diversifying stocks and bonds, but we think about diversifying financial assets to real assets to your own investment in yourself and your education and skill sets. So we take a much the 8 forms of capital has oftentimes been talked about on this channel. We couldn't be more endorsing of that kind of broad way of looking at one's financial livelihood and health. So a lot of our time is spent, telling clients or advising clients to do things with their money other than to put it with us, because it's the right thing to do.
Yeah, and I know one thing that you've helped a number of clients that I've seen, which is help them understand that if they want to invest in real estate, that they have options. So a lot of people don't realize that they can buy property through their retirement funds, right? And there's some benefits to that. There's some detractions where you might not be able to enjoy the full tax benefit elements of it. But for a lot of people, that's where their capital is, right? And so to know that they have that option can be really freeing for people. So John or Mike, just before we move on to kind of the markets in general, anything else about real estate and how you've helped, the type of decisions you help folks make, or any reaction to specific things that Victor mentioned?
I guess I just second what John said, that we're big fans of tangible assets. It's outside of the central banking madness that we find ourselves living in, these days. It's hard to know what's real, with the money supply increasing last year, 30% alone. Nothing feels real anymore in these euphoric bubble markets, but tangible assets are real. Like John said, gold and silver and real estate. And, Victor gave a lot of good information there. And we're big believers in buying real estate individually or directly. But also, he gives good information about syndications, which a lot of people don't know about. Most people know about real estate investment trusts, which are either traded on the stock exchange or not traded, called non-traded REITs. But there's these syndications, which actually look and sound pretty interesting too, because you have direct participation in as little as it sounds like maybe even one multi-unit property. And you don't necessarily have to manage it like it has all the benefits of a real estate investment trust, with, it seems to me, a little bit more control and more visibility about what you actually own. I mean, we're not, for the record, we're not involved in any syndications or anything like that. I'm just saying that what he was saying sounds very interesting and probably worth looking into. But that's all I have to add.
Okay, great. Well, look, let's move on to the markets. I got a ton to pound through here, so we'll go as quickly as we can here. We continue to be dealing with just historically unprecedented times here in the U.S. We talked earlier about the massive scale of liquidity that's been pumped into the system. I just wanted to quote an article by Charles Hugh Smith, who is a big frequent Peak Prosperity contributor. Here he is actually quoting Foreign Affairs magazine. But Charles, before he quotes, he says, inequality while gutting the bottom 90% is becoming glaringly obvious to those not blinded by the current euphoria. And then here's what this section he takes out of Foreign Affairs. I'm just going to cut to the chase here. 10% of Americans now control 97% of all capital income in the country. Nearly half of the new income generated since the global financial crisis of 2008 has gone to the wealthiest 1% of US citizens. And here's the kicker. The richest three Americans, collectively have more wealth than the poorest 160 million Americans. We're a country of 320 million people. So 3 people have as much wealth as the bottom 50%. That's how out of control things have gotten. And I know we get a lot of flack on YouTube for continually kind of raising the bell of the deformation of the current system that we're in, but there are big reasons why, and that is a huge, huge reason. The inequity here, it's unjust, it's unfair, it's having all sorts of deformations in the economy and in the markets that are going to be highly beneficial for that very few elite top, and all the pain goes to everybody else. So we're going to keep waving that flag for as long as we can, or as long as we have to. some initial data points that have come in. We're still seeing lots of people lose their jobs. 900,000 initial jobless claims were just announced this morning. So we're still near 1 million a week. That's not getting better as fast as people were hoping. And we're seeing a lot more warnings now from, every week we kind of talk about the latest, kind of financial celebrity who said, hey, this market's crazy. Those are coming fast and furious now. Bank of America is now added to the list of big banks, including Citibank and Goldman, who have come out and said, this market's now crazy. Bank of America specifically said, sentiment and valuations are becoming euphoric. Our sentiment indicator is now closest to the sell signal since the great financial crisis. Also, another well-known hedge funder, Seth Klarman, has basically said that this is the craziest market he's ever seen. I'm just going to throw up 2 charts of his, because basically his whole commentary is a rant on the central banks deforming markets with this liquidity and making people think that risk is not nearly as extreme as it currently is. So here's one chart of the S&P since March, and you can see how it is just a one-to-one relationship with global liquidity. That basically the only reason the markets have gone up the way they have is not because of economic recovery. It's simply because more money's been shoved in the system. And it's followed by this chart, which is a chart of the non-profitable tech stocks index, which is just showing you how valuations are just shooting the moon in completely unprecedented levels in unprofitable companies, but people are rushing into these companies because the prices are taking off, right? And that's a clear sign of euphoria. Klarman basically concludes here by saying the market's usual role in price discovery has effectively been suspended. The market basically is saying you can't trust the market signals, they're broken. Last, Jeremy Grantham from GMO, who we talk about a lot, he's been warning quite frequently lately, but he came out with his latest one, or one du jour, warning du jour, and he has said there has never been a great bull market like the one we're in now that ended in the kind of bubble that we're seeing now that did not decline by at least 50%. So sorry for the monologue there, guys, but there's just so many blinking lights all over the dashboard now that we continue to be at these elevated levels of overextension, overvaluation, and we've got a lot of people there, as you guys have been saying that it is not historically out of the ordinary to expect not just a correction, but a correction of over 50%. And of course, we had David Hunter on the other week who thinks it could be more like 80%. So the reason, folks, we keep hammering this stuff home is if you are long this market and you are not hedged or you don't have a plan, you got to be willing to be open to the possibility, maybe probability, that your wealth's going to be cut in half or worse. So guys, I'll let you chime in there, but I know you follow a lot of the same data points I do, but it's just crazy right now.
Yeah, Adam, I'm glad you raised the Klarman kind of commentary. He's a legendary investor. He's very, kind of, I don't want to say reclusive. He's not a very public person, but his track record is legendary. And when he speaks, it's because he's got something to say. And I thought, probably as impactful as some of those charts that he shared were just some of the analogies he used to kind of describe the environment. So, for example, he said, trying to gauge the economy today in the midst of the absolutely off the charts kind of monetary and fiscal policies that are being still done today, even after more than 10 years of emergency measures. He likened it to trying to measure whether you have a temperature after having just taken a massive dose of aspirin. We all know that aspirin can mask a fever and give you some, false readings. That's exactly what he likens the policies that have been done. And he further likens the, kind of a frog in boiling water. Slowly, the water temperature kind of, heats up until it's too late. The frog doesn't realize it's boiling. And basically, the environment has hidden the usual danger signals from most investors. So that's why at bubbles, people get really complacent and this one is particularly dangerous because all the usual signals have been muted and actually distorted to actually psychologically torture people like more than ever to jump right in. So
yeah. And sorry, but you were mentioning his analogies. He had another great one too that I think he concluded with, which was comparing to the markets today to 30-year-olds living in their parents' basements. In other words, really wondering whether the markets are going to be able to get out and survive on their own. At this point, they're almost kind of like a failure to launch. They're just eternally dependent upon the largesse of the central banks, just like the 30-year-old in his mom's basement. So yes, as we've said, crazy making. One thing I wanted to underscore too is about a month ago, or maybe 2 months ago now, we had Steen Jacobson on, who told us that he was very confident that inflation was in the future, and he shared actually his allocation with us, which has done very well since he was on the program. A lot of the commodities that he's invested in have had phenomenal runs since then. He just announced today that he is now 90% in cash, that he is just so concerned where things have gone, that even though he believes long-term in what he shared with us 2 months ago in terms of the secular inflationary environment that we're headed for, he sees the risk of a big deflationary crash as so high right now that he's hopped out of that very profitable trade and is sitting at 90% in cash. And as we always say, guys, words are one thing, but actions are another. And I think that action speaks at a high volume for anybody who's listening. Mike, why don't we flip over to you for a second, just to run down anything that's happened in the week that's caught your attention. I know Bitcoin is in the process of correcting a bit, which is interesting. Last time we talked about what was going on with interest rates, the precious metals, any of those things that you think folks should know about since we last met?
Yeah, well, today is Thursday, I guess the 21st of January that we're recording this. And, at least a couple of the stock indexes hit yet another high today. The S&P is a new high, and the NASDAQ and the Dow is a new high. The Russell 2000 of the small caps, interestingly, is not at a new high, a little bit of a weakness in that index the last couple of days. But over the week, the S&P is up 60 points. So yet again, here we are sitting, recording with the market up again on the week, 50 or 60 points at a new high. It seems a little bit like deja vu, but the signs are just building every single week. It's a little more extreme. It's pretty breathtaking to watch. Gold is, pretty flat, up about $20 on the week. The big thing that, that we're noticing is the continued higher interest rates. The 10-year note at 110, it's holding in there above 110. It looks to be basing and looks to be wanting to go higher. If that starts moving higher, it's really questionable how much more it can move without affecting the equity markets. Volatility is still high, even though it's down a little bit this week. The VIX, or the volatility index, is still above 20 at 21. So even with this monster move, in the stock market, particularly the most shorted in the small cap stocks since October, volatility has remained high. The market's not liking something, and it foresees something. And you just mentioned Bitcoin. Bitcoin has just been an absolute mania. We've got no doubt about the legitimacy of the platform, of the blockchain, but we don't know which one of these coins will last long term. And frankly, I tell you that the euphoria and the buying panic that we've seen in Bitcoin amongst the people that we've talked to over the last few weeks is pretty stunning. And so Bitcoin has went up to like 42,000 per coin, promptly had a 25% decline in one day, went right back to the high, and has now dropped back as of last printed right around 31,000, 32,000. I mean, it's down 10% today. So it wouldn't surprise me if Bitcoin is part of the big parabolic blow off euphoric speculation that we've seen here, and that everything tops at the same time. Another one of your guests, Sven Henrik, had put out a piece today where he kind of postulated the same thing, that, Bitcoin may be raising a caution flag here. And we agree with that too. So the signs are mounting. Bitcoin could be a foreshadow of weakness in the broad markets. Who knows? But it literally could be any time at this point.
Yeah, well, that's another thing that Sven says too, which is he's a very technical oriented analyst, for those of you not familiar with him. And he basically says you can tell when, just like a pile of sand, when you pile up sand over time, you can pardon me, you can calculate the increasing instability of the system, but you can't calculate which grain of sand is going to bring it down. You almost sort of have to Monday morning quarterback it. And really, he says there's really no logic behind it. There's just some breaking point in the system that it hits. And so things go up until suddenly they don't. Manias go up until they suddenly pop. And that's what I think you got to be really cautious of here if you are in this market, is knowing that you're highly likely not going to get some sort of telegraphed warning signal that it's about to roll over. It's just going to roll over.
Absolutely.
So anyways, we'll leave it at that, folks. As we wrap up here, real quick, if you have not already, take a second, subscribe to this channel. The subscribe button is right down there, right beneath the like button. That way, when we release new videos like this each week, you won't have to hunt them down. You'll just get an alert. Also, while you're down there, click the like button. That really does make a difference in how well these videos get discovered and shared across the internet. If you want to know who is going to be on the program in the upcoming weeks, subscribe to my Twitter feed at @MenloBear. We've got guests set up for the next 3 weeks. I'm very excited about all of them. And that's also where I love to hear your suggestions for improvements to this program, new guests you'd like to have on it, et cetera. So please subscribe to that Twitter feed and let me know your thoughts. And then last, guys, as we say every week, we've set up this relationship with John and Mike and their team at New Harbor Financial, really to help people navigate what is hands down the most treacherous time for investors in living history. And if you've been, just watching today, or if you've been watching for the past number of weeks or months, you've seen expert after expert after expert who's, basically more or less said the same thing from their own perspective. And so the guys at New Harbor as a public service, offer a free portfolio review to anybody that wants to talk to them. It doesn't cost you anything. There's no strings attached. It's just your opportunity to talk to a financial advisor who sees the same risks that we do and share the details of your personal financial situation, your goals, and get their opinion. If you're interested in that, just stick around to the end of the interview here. It'll come up in about 30 seconds, and we tell you how to do that. It takes like 30 seconds. Very, very easy. So with that, guys, look forward to seeing you next week. I'm just sort of smelling it, don't hold me to this, but I just smell that something interesting is going to happen. And that's not unexpected after, an administration switch like this, where there's been so much uncertainty that's now been removed from the system. It's funny, systems just sort of have this habit of kind of correcting when everybody is at a point where they think everything's now safe and going to be normal. So again, like I said, don't hold me to that, but let's see what the next couple of weeks bring. But whatever they do bring, I look forward to tracking it here with you guys.
Thank you, Adam. We look forward to seeing you next week.
Thanks, Adam. And I think I smell dinner. So off to dinner, and great to see you again.
All right. Take care, guys.
Take care.
All right. Bye.
If you'd like to schedule a consultation with the financial advisors at New Harbor Financial, simply go to greylockpeak.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given the latest market outlook. They're willing to do this because they care about protecting people's wealth and because Peak Prosperity has connected them with so many thoughtful investors just like you over the past decade. Chris and I started doing this because so many people have approached us in frustration and are looking for a solution because they're feeling out of alignment or just downright ridiculed by the standard sort of financial advisors who have been managing their money. You know the type, the kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, don't worry, the market's always going to take care of you. For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing, which is why we strongly believe that today's investors are best served working in partnership with a conscientious professional advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, just as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you aren't, or you're having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. And for those about to ask, yes, there's a business relationship between Peak Prosperity and New Harbor, which we had to put in place to make sure that everything is handled according to SEC regulations. All the details on this are clearly provided on the greylockpeak.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to greylockpeak.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.